Well, folks, it is official. We are on pace for the worst January in the history of the stock market. In this video, I want to take you guys through exactly what's going on in this market right now. Yes, literally, we are on pace for the worst January in the history of the stock market. And that's saying a lot because we've been through some crazy crashes over the past 100+ years, right? We've been through a lot of corrections. We've been in some drama times. And to think this could be the worst January ever for stocks. That's just, hey, what a time to be alive and what a time to be in the stock market. Oh my gosh, guys. Okay. Hope you enjoy this video. As always, make sure to subscribe to this channel if you're not already. This is Financial Education 3. And also, get yourself some free stocks from Moomoo right now. They're trying to bail us out in the stock market by giving us some free stocks valued up to $3,500 each. Check out the pinned comment for that. Okay. Yeah. So what I pulled up here was from 2009, worst January on record for stocks. Stocks wrapped up their worst January on record with a final plunge on Friday. The Dow Jones Industrial Average finished January down 8.8% on the month. Previously, the worst January for the Dow had been in 1916 when it fell 8.64%, okay? So basically, that's the worst January we ever had. And literally, we're on pace for a much worse January than in 2009. Which, think about that for a moment. That was in the depths of the Great Recession when it looked like the financial system was going to fail, like massive high unemployment, jobs were being lost like crazy, right? And here we are in a January that could be worse than that. Like, that's just extraordinary to think about that. Like, literally, that's extraordinary to think about that right now, okay? So right now, the NASDAQ is already down 8.3% for the month. Now, guys, the reason this is so huge, I want this to hit everybody, is we're only 19 days through the month right now. So if this trend, it doesn't even have to be as vicious as it's been. If we just continue to trend down a little bit, just a few percent, the NASDAQ's going to end up finishing this month probably down 11, 12, 13% if this trend continues for literally just the next, whatever amount of trading days we have left in this month, right? Which is probably 7 or 8 trading days, right? There's more days than that left in the month, but of actual trading days, we've probably got like 7 or 8 trading days left. And so if this trend continues, we're going to be the worst NASDAQ in the history of the stock market, guys. Like, this is extraordinary. Think about the Russell 2000's down over 8% so far. So if this trend continues, we're going to finish down like 12% roughly on the Russell. That's extraordinary. And the Russell's already been hit, right? S&P 500, we're already down about 5%. And keep in mind, it was small caps at first, and now it's NASDAQ getting heavy. Maybe in the back half of this month, all of a sudden it's S&P 500, and next thing you know, we're at the worst S&P 500 as well we've ever had in history of the stock market. So think about that, guys. If this trend continues for just the next 7 or 8 trading days, we will have gone through the worst January in the history of the stock market. That's extraordinary. That's extraordinary, especially when this hyperinflation we basically have going on and what is seen as a relatively strong economy and those sorts of things. It's just extraordinary to think about. We're going through possibly the worst January in the history of stocks, right? Now, this is very important to keep in mind, okay? Let's talk about the worst January on record that never was. This was in 2016. I found this off this random website. Wow, January was quite a roller coaster ride for stocks. After 13 trading days into 2016, the S&P 500 index was down 9% and was setting up for the worst January on record. Then on January 21st, 2016, stocks abruptly changed course. And basically, they finished only down 5% for the month, okay? So this is something to keep in mind, that just because, the front half of this month has been awful and we're on pace for the worst January on record, it doesn't mean absolutely we're going to be the worst January on record, because it could come back, okay? That's just something to keep in mind. I think a lot of folks are that hopeful in this market because they've just been beaten down in this market. So a lot of folks are just like, it's not coming back. We're just going to go down more. And, there's other folks out there that want to say, hey, I've been through the worst January in the history of the stock market. And I will say that's pretty cool, right? I mean, there's a little badge of honor that goes through that. Kind of like if you've been through stock market crashes and corrections and things like that, you kind of get that badge of honor. It's like, I went through that. I think I wouldn't mind if it was the worst January on record, because that's another little badge I can put and I say, hey, I went through the worst January in the history of the stock market. Wouldn't that be something, right? So in terms of today, I looked out there and I want to discuss a lot of these stocks individually and whatnot. And there was some green out there today. It wasn't a lot of green, but there was some green. SoFi had a really good day on the back of their big news here today, up 13%. STC had a pretty good day, up 4% plus. SAM had a pretty good day, up 2.5%. Foot Locker had a decent day, up 2%. And Corsair had a respectable day on a down day like today, up 0.89%. And yeah, that's about where the green ended, and then it just went vicious from there. Celsius Holdings, I watched this one. I keep this one on my watch list. It's a growing drink company, very exciting company, but always trade at a very, very high valuations, price to sales ratios, or any metric you pretty much want to look at. And this one's just been devastating. It's pretty much at right around roughly a new 52-week low. But look at this stock. It went from $100-something a share in basically the beginning of November, when the Russell was flying high. Flying high is a relative term. And basically since then, it's just been vicious for Celsius. And that's the most exciting probably. There's one company I know of that we're going to talk about that's a more exciting drink-related company than Celsius Holdings, but that's the second most exciting drink-related company in all the stock market. And it fell off a cliff. Like that's a 50% plus fall in a matter of, a 3 or 4 month span. That's extraordinary. Look at Lemonade, new 52-week low for Lemonade. Think about this for a moment. This was a stock that was $182 11 months ago. $182 a share 11 months ago. And here we are today. Lemonade is at I don't want to say an all-time low, a 52-week low of $31. You can't find a buyer for that stock. And it just seems like the selling pressure is unrelentless in Lemonade stock. I mean, that's nothing short of extraordinary. If it wasn't for the fact that there's so many other stocks in the market, I might even step in and be a buyer of Lemonade. But the fact is, there's just so many other stocks for me out there right now. There's at least 15, 20 stocks I can think of off the top of my head that I feel like are buys right now. That's just an extraordinary market we're in, right? And Voyager Digital, yeah, they've posted as great a numbers as you could possibly post in terms of how many customers they acquired, their assets under management, everything over the past 18 months. But it doesn't matter. In this sort of market, you get thrown out so dang fast as nobody's business. Voyager Digital down to $9 a share now. Just extraordinary. Look at the hood. Who would have thought Robinhood under $14 a share? Is in the 13s today, a new all-time low for Robinhood. And to think this was a stock that just back in the summertime, we don't even have to go back to January, February of 2021. We could talk about this summer when it went public. It reached a high of $85 and it's 13 and change today. That's the type of fall that is nothing short of extraordinary. And the worst part for Robinhood, the worst part is, and we talked about this on Millennial Money last night, the worst part for this company is their comps the next 2 quarters are vicious. And when I say comps, if no one knows what that means, that's basically year over year. Wall Street likes to look at what your year over year numbers are, what your revenue growth is, your amount of customers you acquired over year over year, assets under management. And their comps are going to be near impossible for the next 2 quarters, if not the next 3 quarters. And so this just puts Robinhood in this extraordinary situation where it's like, where is the bottom for the stock? And they've got an incredible amount of cash, and there's still a ton of people that use Robinhood. We know that. But this is one of those stocks that it's just like, it's been so devastated, but it can go down more, not just because stocks can go down more, but because the comps are ridiculous. They have to comp against year over year for the next several quarters. And that just makes this type of stock like, who's going to step in and buy? And that's a tough thing in this market, and you just can't find the buyers, okay? The Chef, one company I'm not scared of at all in terms of their numbers over the next several quarters is the Chef. I'm very, very confident in this one, but it's just relentless selling pressure on the Chef. 1382 on this stock here today. That's just extraordinary. I go to Targets, I do the walk-arounds of the stores, and what do I see? More and more products. I see sell-through through the roof. I see this company posting ridiculous numbers over the next 10 years. Like, it's not like this is just a 1-year story, over the next 10 years. But in this type of market, let's just be honest, no one wants a company that went public in the past 2 years or a high growth company. Those companies are thrown out right now. Even super profitable high growth companies are thrown out right now. People are like, look at PayPal. That one I think hit a new 52-week low also today. Fubo just continues to drop like a rock, under 12 now a share, $11. Like, that stock just new 52-week low after new 52-week low after new 52-week low. Companies made great progress over the past 1 to 2 years. This is a joke. 2 years ago, Fubo was a joke, okay? They're actually a very respectable platform now, have a great amount of customers, have incredible revenue growth, but who wants a piece of this stock in this market, right? Long term, it's a pretty darn attractive stock, but in this type of market, people, no one's touching that. If you're not touching the chef, you're definitely not touching that one, right? Because that one's a crazy money loser, and people don't know when that one's going to turn it around. Look at Palantir. Palantir is expected to be profitable in 22. I think they're going to be profitable in 22. I'd be very surprised if they're not. Stock just hit a new 52-week low, 14.56 on this stock now. Just continues to get devastated. I did a full in-depth video on Palantir stock on the main channel earlier today, probably 6 hours ago or so. So if you want to check out that video, that was posted on the main channel, Financial Education, and that went all into depth on Palantir. We went through valuations of that stock and many various things. It's a pretty dang cool video if you didn't get to check it out if you're interested in Palantir. Square stock, another 52-week low for the stock. It breaks. This is a story for so many of these stocks in the market right now. They break through 52-week low after 52-week low after 52-week low. And it is anything with higher growth. It is anything, when I say higher growth, I'm talking like, type of companies that usually grow around 20% or so. Anything a higher valuation, these sorts of stocks just aren't in favor right now, and they break through a new 52-week low after new 52-week low. Oatly, this is the most exciting drink-related company in the entire stock market. You're not going to find one more exciting than this one. Under $7 today. It dropped under $7 here today, hit $6.85 roughly on this one. I'm extremely bullish on this company over the next 5 years. If you're really, really up on what's going on in the oat milk industry and, all the other products Oatly has coming out, their sell-through is ridiculous. Like, they'll stock the shelves and it's out. I've never seen a drink-related company sell through the way Oatly's selling through. And I do the walks to these stores all the time, and it'll be a full case, and then a day or two later, there's nothing up there. And it's extraordinary. I've never seen anything like it. And so, but does the story matter right now? No. Does the revenue growth story matter? Does it matter that analysts have this company growing like 60% revenues next year? No, it doesn't matter. Does it matter that this business is going to be a profit machine, a cash flow machine over the next 5-10 years? No. None of that matters in this sort of market right now. Now, let's talk about margin debt. I know there's definitely a lot of folks in this market that are getting beat down, that are out of cash, let's say, for instance, and then folks wondering, should they take out margin and those sorts of things, and we got to talk about this, right? Margin debt was down in December from what we're seeing, down about 1% roughly. I wouldn't be surprised if that number is even quite a bit lower now, considering the market just dropped like a rock. And, usually when you're in that sort of market, margin debt evaporates. People sell, they cash out. People aren't as enthusiastic about margining out. It's just like, you would think it would be opposite, like stocks would go down, people would feel more incentive to margin out. But actually, traditionally, what we see is when the market goes down, margin debt goes down massively. One could be margin calls. The other part of that could be just folks feeling like, oh man, this market's just going down and down and down. I don't want to take risk in this sort of market, which is kind of the vibe, right? Because what do we see? If anything, a rush to cash or a rush to what is seen as safety stocks and out of anything that has risk, okay? Now, in regards to margin and those sorts of things, because I know folks, you got to be careful. Okay, you got to be careful. First off, margin's not usually for most folks that are investors in the market because most folks just don't have the experience. But secondly, you got to be careful because I understand we just went through those stocks, and a lot of those stocks people feel like are at silly values, right? You're looking at Oatly at under 7, you're like, dude, that's stupid. Like, that's going to be a $30+ stock a few years from now, or Palantir, and people have price targets of $50 to $100 over the next few years, but it's at 14, or people look at the Chef at 13, and they're like, dude, that's a $100 stock by the end of this decade, or the Hood, or whatever stock it is in the general, right? And these are just kind of some of the more ones that have been beaten down, a lot. But there's a ton of them, even like stocks like PayPal, even Amazon is down $300+ a share in the past year and a half. Even a stock like that, people are looking at it like Amazon, like, come on, that's easy money over the next 5+ years, right? The thing you got to be careful with when it comes to margin is if a stock's at a stupid price where it's stupid undervalued, it doesn't mean it can't get more stupid, okay? And I've witnessed this before time and time again with stocks where they'll get down to values and it's like, this stock is really trading at this? Seriously, this stock's going to be, massively more expensive 3 years from now, 5 years from now, even a year from now, right? And at the end of the day, it doesn't mean it can't just tank a bunch more. And so if you go super heavy on margin, there's no telling, like, who's to say the chef doesn't go to from 13 to 10? What if the Russell pulls back another 10, 20%, right? Who's to say that can't happen? And so you go super heavy in and on it, and you're like, oh, this is easy money. The chef's easy money, right? But it doesn't mean you can't get margin called in that in-between time. And then all of a sudden, you're forced to sell the stock at 10, 11, right? And the chef does everything right over the next 5 years. The next thing you know, it's a $50 stock, $70 stock, whatever. And you're like, I was right about that one, but, I got margin called on it and sold out. And so that's where you have to be very, very careful if you are somebody that's using margin out there, is just because a stock you think is disgustingly undervalued and you think that stock's going to beast over the next 5 years, doesn't mean that in the short term, it can't even go down more. Doesn't mean the stock can't drop another 20, 30%, okay? And so that's where you have to really do risk management, and that's something that most 99% of investors can't really do that proper level of risk management and really think about it and say, okay, if I go 20% on margin, what happens if this stock falls like this and things like that? And if there is anybody out there doing that, just play around with the risk calculators. Fidelity has a great resource for that. Fidelity Investments, in terms of trying to figure out, like, if my stock dropped ... or if the market drops ... or my entire portfolio drops this amount, right? What would that put me in a margin call? What would that put my ratios to, and those sorts of things? Because it's a dangerous game to play, and it gets very, very stressful, especially in this sort of market, because all you see is 52-week low after 52-week low after 52-week low, and it's unrelentless. And so you get in this situation where you're like, when's it end, man? And I mean, it's sooner rather than later, more than likely, but that doesn't mean in the whatever that sooner is, it doesn't mean it can't go down more. And so that's the vicious part of kind of margining out, which is investing money that you don't have. And so I just want to kind of tell you guys about that side of things as well, okay? So anyways, much love. Keep your head in this market. Stay focused on the long term and those sorts of things. At the end of the day, if you're buying great companies, they're going to beast over the coming years. And it's just, you have to go through these time periods that are just vicious. And they tear you up. And it's what makes or breaks the investors at the end of the day. These sorts of markets, when you're on pace for the worst January in the history of the stock market, these are the sorts of markets that make or break investors. And the ones that make it through, those will be the ones that will be around long term. And the ones that drop out, they're never coming back. Much love as always, guys, and have a great day.